Hey everybody, it's Beau Benjamin here with Beau Benjamin Realty Group, and we are here for the first time home buyer webinar. We're going to jump straight in and get through this fairly swiftly because we'll want to leave time at the end if there's any active questions. So let's jump right in. Tonight we'll go over the following. We'll start with you have to have a budget. Next we'll jump right into how do the lenders know how much to loan me. Third would be the different loan types that you can try to get approved for. Fourth is having the right mindset in this process. Fifth is the diagnosis. Sixth, you're approved. Now what? Process of elimination, not selection, and what are the costs? All right, we'll jump straight in. Let's go to have a budget. I have a Google Sheet. If you want it, you can reach out. Be happy to share it. A Google Sheet's easy. It's accessible everywhere on your phone, tablets, whatnot. You can always update it, make adjustments anytime. And just starting a template out, I mean, the basic budget is an income on one side and a list of expenses on the other. So everyone probably has basic expenses like water bill, electric bill, internet bill, things like that. You want to list those out. Everything that you can document that you know you have to pay is going to really help you out in this process. And then I section mine off into kind of the have tos, and then I'll give a little space, and then I'll put the adjustable things. So entertainment, movie, eating out, stuff like that. And those can adjust. I can decrease those if I want, but I can't really decrease my water bill other than trying not to use as much, I guess. But I'm always going to have a baseline water bill. All right, so make that budget. Why do we make the budget? Because one huge thing is it's going to show you a big line item here in the third bullet is rent and mortgage, right? So you're probably already paying rent unless you're living with a family member or a friend. Even then you might be paying them rent, but you have a rent line. We're already paying this expense, and most of the time it's as much or more than an actual mortgage would cost us. So putting that line in, and I like even putting it as a rent/mortgage. Give yourself that mental awareness that I can change this from rent to mortgage in the future, if not now. All right, and then find out what you're comfortable with. So use mortgage calculators to reverse engineer what price home you want. That is something we'll kind of go over today. But just know that once you know what you can afford for that rent mortgage line, then you can start looking into how much of a home can I afford. If you don't have a budget, though, you're never going, well, I can't say never, you're much more unlikely to actually achieve home ownership. And the reason why is a mortgage is a must-have. It's like the water bill. It's like the electric bill. You got to get used to living within your means so you know that you can pay that mortgage. If you don't pay rent, you might get behind a little bit. The landlord might let you catch up, etc. Mortgages aren't quite as forgiving. Banks will foreclose on you. So you want to get used to having this budget, knowing how much you can afford. And we're going to go over the affordability and how to do that later. Let's go on to the next one. Actually, we'll jump straight into it here. So how do you know? Well, I mean, the easy way is just go get a pre-approval from a lender, all right? And we'll talk about that in another slide as well. But let's just talk about it high level. And this is not a strict, one size fits all, and I'll kind of get into that. But start with your gross monthly income. It's important to understand what gross means. It means your monthly income at the highest level before they take out any 401k, before they take out any taxes, before they take out anything. So if someone makes, let's say, $60,000 a year, that's what your salary is, then you divide that by 12, and that's $5,000 a month gross salary. All right. You're starting with that number, and then you remove the revolving debt payments. And I just put here school loans, car loans, credit card debt, boat loans if you have a boat for some reason, and before you have a house. Odd, but could happen. Debt consolidation loans. So say at some point you combined everything. That's a monthly payment that you have to do every month. Now, this does not include utility payments. A lot of people might think that or ask that. It's not utility because you can shut a utility off anytime you want. These things are long-term revolving debts that you have to pay off or they're going to collect on you. All right. So the mortgage lender typically is going to take that example over here on the right side, $5,000 a month, and they're going to take all those revolving debts out, and then you're going to have what's left over. That's in our example on the right here. It's $38.50 a month after you take off some of these revolving debts. All right, most lenders, and I put in here a note, typically varies with credit scores, will lend you up to 49.9% of what's left over. They know that utilities and things are going to eat up. You got to have food, you got to have gas to get around. So they know half of the remainder is probably going to expenses that you need money for. And they're willing to let you loan up to the other half with a mortgage payment. All right, 49.9, not half technically. Now, if you have a low credit score and you're barely sneaking by on the credit score, they may decrease that to 45%, 40%, whatever that mortgage lender feels comfortable with, and based on their documented standards at their lending institution. But from a Fannie Mae, Freddie Mac type government-backed loan, I've seen it go up to 49.9. My mortgage lender tells me that's what they do. So that's a good rule of thumb. This is a good example you can take with you, plug in your numbers, and figure out what would that red number be for you. All right. And that's where you can go to mortgagecalculator.org and you can plug in numbers. And we might do that as an example at the end here. You can plug in numbers and figure out, okay, if I got a mortgage and the payment equaled $19.21 a month, what would the house be worth that I could afford? That's how they pre-approve you up to X dollars. They do this calculation and they come up with the amount and they say, we'll loan you enough money to buy a $300,000 house per se. All right. So we'll get more into that. Use the mortgage calculator. It'll be good to see that in action. Next up, loan types. All right. So most people that haven't done this before may not have any clue that you can get a bunch of different types of loans. All right. I put the most common first-time homebuyer loans on the left here. The first three are actually government subsidized loans. All right. So FHA, VA, that's veteran loan, and then USDA. USDA, someone may say, is that like the beef? Actually, it is. It's the same entity, but USDA loans are only available in rural areas typically, and there's usually maps you can cross-reference to see if it's an available loan for that property. All right, so the big deal with the VA and the USDA is 0% down. That's absolutely huge. If you're a brand new homeowner, home buyer, you never bought a home, you're thinking, how much is this going to cost? Well, they'll actually approve you for 0 down as long as all the other things stack up, right? FHA is the most common first-time home buyer loan, I would say, and that's 3.5% down. So on a $100,000 house, that's $3,500 down to start the home buying process. All right. Conventional is probably the second most popular. It's the most popular second and onward home loan product, because once you have equity and you've owned a home, you typically have a down payment 5% or more, and conventional gives you the best terms. So with FHA, VA, USDA, there's going to be fees associated to allowing you to get that first-time homebuyer loan, and they're built into the loan product. So they're not the best loan per se, but they give you the best chance at getting a home the first time. So they're used commonly. But once you get to your second one, and if you can save up 5% down in your first one and have good enough credit score, you can go straight to a conventional. That's the best terms. That's where you can get the best terms for a loan, which is another way of saying the cheapest to you for loans. On the right-hand side here, we have loan terms and types. So I just wanted to quickly discuss the first-time homebuyer loan, probably not getting a jumbo loan. However, in New York, California, coastlines, you might, because if you have a high salary, which, wages are higher on the coast typically, but so are home prices. So, and jumbo loans are products that allow you to take out more money, and the banks have a different kind of approval process for those. So you can ask and certainly see if it's a fit for you, but it's not as common with the first-time home buyer. The fixed rate and adjustable rate. These are two huge terms. I wanted to jump in on this because it's very important to get educated on this. Fixed rate loans are probably what most people think of when they think of taking out a home loan. It just means that for your term, which the most common term in a home loan is 30 years, you can get 20 years, 15 years, 10 years, etc. But the most common is 30. And what it means is you'll have the same interest rate the entire 30 years. So if you were lucky enough to buy a home in 2021, you probably got a great fixed rate loan for 30 years, and you probably don't want to move anytime soon because you want that nice 2.5 to 3.5% interest rate for 30 years. You never have to pay any more than that. On the contrary, though, adjustable rate mortgages, or ARMs as they're sometimes called, they adjust after a certain period of time. So you can get 5-year, 7-year, 10-year ARMs. And what that means is for the first segment, like a 5-year ARM, means they'll give you that interest rate for 5 straight years. But after that period of time, it's going to become adjustable. And it goes up and down based on the federal advertised rate. All right, so you got to read the terms closely on this one, because this is actually what was a big factor in the 2008 crash. The lending institutions were not only loaning money to people that maybe not, or maybe shouldn't have qualified for the loan. That was a whole nother topic, but they were commonly loaning people adjustable rate mortgages. And let's rewind 5 years before. So 2003, this practice started becoming prevalent. Well, guess what happened in 2008? A lot of these became adjustable rates, and the rate was much different. And at that point, the monthly payment can go up. So when your interest that you're paying as part of your payment each month goes up, then the monthly payment goes up as well as a whole. So these are kind of dangerous. I mean, if you know what you're doing and you read the terms and you're very well educated, they're not dangerous at all, because you know what's going to happen. However, they can be very dangerous to someone thinking my payment's going to be the same forever, like a fixed rate, when it's absolutely not. All right. PMI, or private mortgage insurance. Now, on the left, you see the percent down. Usually a first-time home buyer will put a low percent down. A lot of times they want the least amount out of their pocket. They haven't saved up a bunch of money on the side, and they don't have a bunch of money to put down. So the lending institutions don't want to foreclose on the house and have to go through a lot of trouble, and then maybe the house has been wrecked on the inside because the person didn't take care of it. They didn't pay their mortgage, so now it's getting foreclosed on, and the lending institution gets the house back, and it's worth 20, 30, 50,000 less than what it should be because of the damages and not taking care of it properly. So that's where PMI comes in. So when you put less than 20% is usually the number. When you put less than 20% down on a home loan, most lending institutions will force you to pay PMI as part of your monthly payment. And it can vary from $20 to $150, maybe even more, but it's a factor. So if your whole mortgage payment is $1,500, a sliver of that is toward paying private mortgage insurance. So a lot of people, especially with the second home, they want to put down 20% or more, because that gets rid of that, and it's not just going to an insurance company, right? We don't like to just give away money. We want it to be going to pay down our loan instead. So that's the key there, is 20% is typically the number. And by the way, just one little quick output is, if you get your home paid down to, say, 21%, you've paid it down to you only owe 79% less, you actually need to call the institution, and a lot of times they'll make you fax like a written request to get that removed. It will fall off automatically around 22%, I believe, is the number. It's by, I think there's a law actually that they have to drop it at that point, but that 2% gap, they'll let you keep paying it even though you don't need it anymore. So always check on that if you're getting close to that number. All right, let's move on. All right, mindset. This is such a huge thing. So it is really hard to get that first house. I'm not going to make it up, say it's not, but saving that money to the side, even if you're just saving $10, $20, $50 a month into a savings account to build up your down payment, that is absolutely huge. for getting that mindset, because once you own a home, right here on the screen, it shows you homeowners have a net worth 40 times higher than renters on average in the US. Now, there's a saying I love to tell people that's kind of goes hand in hand with this is you're paying someone's mortgage. It's either yours or the landlord's. So a lot of people is like, oh, I can't afford to pay my mortgage. Well, you're paying somebody's. You're paying someone else's mortgage if you're renting. So most landlords are going to rent to you, even in an apartment. An apartment is owned by a landlord, by an owner, and they're taking all those rents and they're paying one commercial loan payment, and all those renters are contributing them to pay down that commercial loan, and as they pay it down, they become wealthy. And really, they're not doing much of anything. Now, they have to cover it if they suddenly have a lack of renters. Sure, they're on the hook for it, but most investors are smart, and they put enough down to where they can buffer. And this is just home ownership. Pay your own mortgage. Don't pay a landlord's mortgage. That's how you build your net worth up. And the more when you start this process, it's so crucial to do it as early as possible in life, because as soon as it's a forced savings account, you start saving money every time you make your mortgage payment. You save some money, you save some money, you save some money. Then when you go to sell it, you get all that money back, and then you can use it as a down payment on a bigger house, more than likely, because you're probably at the starting a family phase in life. So it is a huge thing. And on the other side, here's the other thing. It's a two-part. So I always like to show the V. I don't know if I can do this on the thing here. So you're going up one way, and actually I'll do left to right this way. You're going up and down at the same time. That's why real estate is so crucial. Most millionaires in US history have been made from real estate for this exact thing I'm getting ready to tell you. A home is a two-part win. All right. When you own a home, when you're living in it, it is appreciating in value. I can show you. Want to do a private one-on-one session, please set it up with me. I can show you this in great detail. Home values have always went up with a few little blips in depression years. But if you look at the big graph all time, it's just up and over, up and to the right. So it's an asset. An asset is something that gains value over time. So when you own a home, it's making money for you just for living there. You don't have to do anything. You just have to maintain the condition of it, and it will make you money. All right. At the same time, you're paying down a loan where you owe less money. So that's the V that I was talking about. You're actually gaining on the upside, and you're gaining on the equity because you owe less money. All right. So when you sell it, you get the double gain. This is called leverage. You're leveraging the bank. Think about it this way. If I wanted to put $1,000 into the stock market, I could go buy Apple stock for $1,000. I'd own how many ever shares that got me of Apple stock, and it would go up over time, most likely. All right. And say in X amount of years, it's worth $2,000. I sell it, I get my $2,000. That's great. All right. Owning a home would be this scenario in the stock market. If I borrowed, Jennifer's on here with me, I borrowed Jen's money. I said, you know what? I'm going to put $200 in of my own money, and I'm going to take $800 of Jen's money. All right. And I'm going to now buy $1,000 worth of Apple stock. And then I'll take the same amount of years, X years, and I'll sell it for $2,000. And I just pay her back her $800. So you see over time, I'm gaining the appreciation, but I only had to use $200, where in the other scenario, I had to use $1,000 of my own money. So when you only have to use $200 of your own money, 20% down on a loan, or the first-time home buyers, 3.5% down, maybe even 0 down, you're using someone else's money to make your assets grow, where you get the ownership of the house and the asset grows for you. So that you can buying stocks like that example is called buying on margin. It's looked at as being very dangerous and risky in stock market trading, because stocks are volatile. They go up and down. You can lose your money, and then you still owe the person money. So it can go bankrupt. So it's a dangerous game. In real estate, it's not considered nearly as dangerous, because the all-time graph of real estate, it doesn't go up and down like a stock does every day. It goes up and to the right. So it's very much considered more safe to borrow money from a lender and then give it back over time. And then you're making the appreciation off of the lender's money effectively, because they're the one putting up most of the money. That's a pretty complex example. But again, I'd love to do this on a whiteboard with you, or go over it in person. If you want to set up a meeting, please reach out, because it's a very important aspect of why you should own a home and build your net worth instead of a landlord's. All right. Diagnosis. You can't know what your plan is until you get a diagnosis. I cannot tell you how many people I meet that say they want to buy a home, they're going to buy a home, I'll get around to buying a home, I was thinking about buying a home, I know I need to buy a home, just everything in the world. And I've come to learn, most people, when they say this and they won't give me the real reason behind all these statements is, I'm scared that I might find out I have bad credit. I'm scared that someone's going to find out, maybe me as the realtor or the lender is going to judge me or whatever when they run my credit report and see that I owe this back debt or school loan or old medical debt, and I'm embarrassed by it, etc. I use this example a lot, and I know it's a little sensitive, but it really hits home. If I have cancer and I say I'm not going to the doctor to diagnose it, it doesn't mean I don't have cancer anymore. But that's what these people are saying when a first-time home buyer knows that it builds wealth, knows that it makes their financial life better, knows they need to do it, but they say, oh, I'm working on it, or I'm getting to a point where I'll go try to get pre-approved here in a little while. Well, you're not getting any better from saying those excuses. At the end of the day, you need to go get a pre-approval, do an application with a lender. Most of the time this is online. It's pretty quick and easy these days. And you just go to the lender's website. They'll give you a link. You type in the information about yourself. Most online applications are just relying on your honesty. If you try to fib on them, they're going to find out, because you have to go through a whole month process when you get a loan, and underwriters find out everything about you. So there's no use in trying to fib on it, because they're going to find out. Just tell them the truth. Tell them what's going on. They're going to pull your credit report and they're going to figure it out. But here's the thing, you get your diagnosis. You may be, I can't tell you also how many people have done this process and then were kind of intimidated to do it, and then they come out and they're approved. And they thought, oh, I didn't think I was going to get approved. But the truth is, like, the government and our society, our government, our culture is set up to promote home ownership. So most people want you to get approved and own a home, because it helps the economy. It helps our whole society out when that happens. The real estate market in the U.S. accounts for $16 trillion, I believe, of the U.S. GDP. So every year's economy, 16% of the total GDP every year is made up of real estate activities. So that's buying and selling houses, that's fixing them up, repairing them, buying furniture, rehabbing them, buying new carpet, doing things related to real estate in those industries. 16% of the U.S. economy, which happens to be the biggest economy in the world. So it's a big deal, and the government knows that it wants it to be healthy. So buying a home is promoted. Everybody wants it to happen. So don't think I'll get around to it. Think, let me go see if I'm approved, and if I'm not, the lender, if you have a good one, we can refer you a good one, will give you a plan of action. Here's the steps you need to do. Here, if you pay off that credit card and you lower the amount you owe on your car by $1,000 or whatever the case, they'll give you steps. They'll say, they have simulators now where they can actually simulate, if I do this, I do that, then it'll change your credit profile, it'll make you approved. So they give you a diagnosis, a plan of action, and boom, you can get approved. That's the way you do it. You have to take action and take steps towards home ownership. It's so critical. And if you don't do it now, when are you going to do it? All right. So we get through that. We're approved. Now what? Well, of course, you got to meet with your realtor. All right. You can actually meet with me or your realtor of choice Prior to the pre-approval, they usually know good lenders. They have good relationships, good referrals. So you can do the realtor first, or you can just go check with your lender first. Either way is fine. I would go with the realtor first. Honestly, I probably put this out of order because that way they can start helping you and they know good people to work with. All right. But meet with your realtor after the pre-approval, because now you're going to have a number, right? We went through that math example, and you get a number. Say you're approved $300,000 home. Say that's about the average in the area I work in. So say you have that pre-approval letter. All right. Now you have the power to go shopping. All right. Next, you create a list of preferences. You don't have to do this like at the realtor's office or over coffee. You can. They're very helpful with this. You can just make a list at home. And a lot of people like to surf the third-party websites like Realtor.com and Redfin and Zillow, and that's the kind of starting point. Right? Just surf through pictures, make a list of preferences. All right. Another thing I love is, oh, by the way, likes and dislikes. Dislikes are just as important as likes, because if you tell your realtor what you definitely don't want, that helps a lot. And I'll get to that on the next slide. All right. But drive neighborhoods. I can't tell you how many people kind of don't do this anymore because we're all online, all digital people. You can get a lot out of driving a neighborhood. You can see if it's quiet in the evenings, or if it's loud, or if there's kids there, or there's older people there, if there's walkers, if there's bikers, if there's places to do activities. You can see if there's danger, red flags, things like that. So you get to learn a lot, and I love doing it, right around the start of the day, going to school and work. There's a lot of activity. There's a lot of activity right towards the end of the day. So if you can go through a neighborhood at those two times, you learn a lot about the neighborhood and whether you might like it or not. All right, last, amenities, things the neighborhood offers. HOAs usually might pay for a pool or playground, tennis courts, basketball courts, etc. And then also nearby entertainment, utilities, shopping. Where do you usually spend your gyms? Where do you usually, that's what I put utility for. Where do you spend a lot of your time? Because you don't want to just see a house online and be like, oh, I want that house, and then come to find out it's 35 minutes from everything you normally do. You're going to end up selling that house and going back and buying another one where you want to live and work. So make sure it's the location. That's the old saying, location, location, location. That drives a lot of home purchase decisions. All right, let's move on. This is huge. I cannot emphasize this enough. The process of buying a home. Now, if I polled 100 first-time home buyers, I bet 99 to 100 of them would get this backwards and wrong. All right. The most common misconception of home purchasing, home buying, is that I'm going to select the home I want. All right. You're like, yeah, that makes sense. Why? That's how it should be. There's a minutia bit of truth to that statement. The best way to buy a home, and this is where a realtor will help you out tremendously, because I go over this with all my buyer clients. We're going to eliminate as much as possible. You might have remembered me saying, I need your dislikes as much as I want your likes. We're going to eliminate the locations you don't want, the school systems you don't want. We're going to eliminate traffic that you don't want. We're going to eliminate, if you need to be around a religious facility or a workout center. We're going to eliminate the rest, because I promise you, there are a lot of buyers without a good realtor that knows this and knows how it works. They will go all over the city. They'll zigzag, they'll go every which way, and they will see 20, 30, 40, 50 houses because they can't figure it out. And the reason they can't figure it out is because they're trying to select their home, and they're just going willy-nilly everywhere, and they haven't went through the process of elimination. If you get rid of everything you don't want, then you're going to all of a sudden create a very specific circle around what you do want. And then here's the other thing. This is even more important than all the stuff I've said so far. When it comes up, you will attack it, and you will get it, and you will pay what's necessary to get it, and you will have your perfect new home. All right. That's the key. You're ready. You're mentally prepared to purchase a home when you've eliminated everything else and you're waiting. It's like, I grew up in Southern Indiana, so forgive the analogy, but when you're deer hunting or something like that, you're waiting, you're being patient. You know exactly what you're doing. You set yourself up on the trail. You set yourself up right where you need to be to get the home you want. All right. But if you're going off selection and you're looking at all these different places, you might find the one that should be the one for you, but you're selecting and your head's spinning and you're like, well, I like that one, but I also like this one over here. And all of a sudden you're like, well, let's go back over here and look at this one. And then this one sells to the person that was actually eliminating everything else. And as soon as they saw it, they went after it. And I'll get the next one, right? So it can go on forever. Like I said, some buyers and some realtors will just go through that process over and over again, and they won't realize it's a process of elimination. All right. What are the costs? So let's go down. This is, I think, one of the last slides that I wanted to go over because this is an important one, and then we'll kind of do a example maybe on the mortgage calculator website. But here we go. Down payment. So we talked about this a little bit. Down payment, you can go as low as 0 if you get the right loan product. And while I'm on that topic, as low as 0, even if you're going 3.55% down, also something I'm going to go back and put in the slide, there's grants too. There's all kinds of grants depending on your location, your economic status, things like that. Government offered grants, location offered grants, things like that. That sometimes cities and townships want an area to grow, and they're investing money into it, and they offer grants for that area. So if you buy a home in that area, you can apply for that grant and have them pay part or all of your down payment. So again, working with a great realtor that knows how to get these and a great lender that knows how to get these is so important. All right. So your down payment, and then typically 3.55% are common. 10%, there's not really a win or anything associated with 10%. 20%, again, you drop the PMI, so people put that much down particularly. And then 25%, if you're an investor, you know that most lenders want 25% down for an investment loan. All right, the next part of your cost of buying a home is earnest money. We haven't really touched on this at all. So earnest money is kind of what I say, putting your money where your mouth is, right? So let's do the quick example. I always do the analogy of, when you're a little kid in elementary school and you make a bet with someone, there's always the middle guy that holds the money, and just, that way they can't, say, no, never mind, I wasn't really betting you, and take their money back, right? He's got the money, he's holding it, he's going to give it to the winner. All right, earnest money is kind of like that in a way. That's how I think of it in my head. All right, you got the seller and you got the buyer. And the buyer says, I want to buy your house, seller, and here's my offer. Seller says, okay, I accept your offer. And now the seller's taking it off the market, which means that another buyer that would have came the next day might have bought it, might have even paid more for it, right? So the seller says, if I'm going to take this off the market and risk, not getting these better offers or having a better offer come along, I need to know you're going to finish this process, right? You're not just wasting my time, because this process takes about 30 days. And that's a long time for a seller to be in limbo, and then the buyer get cold feet and say, oh, I don't want to do this anymore, right? So the middleman, the guy that holds the bet at the playground, is usually the title company or one of those brokers in the transaction that have the proper banking accounts to do this. They say, I'm going to hold the earnest money in this account, right? No one's allowed to touch it. The only way you get this earnest money out is if everybody signs an agreement saying it goes to this person or this person, all right? Or the home closes, and then, as you see in my note here, it goes towards your down payment. All right, so the earnest money in Indianapolis market tends to be about 1%. So again, if we're using the average home in the Indy market, North Indy suburbs where I'm at, 300,000, that's about $3,000. All right, you can negotiate, doesn't have to be that, but that's most common. All right, refundable. So buyer puts down $3,000 within 2 days after they agree on terms, and it goes pending, and then it goes towards that down payment. Now, if the buyer decides to back out willy-nilly, no reason whatsoever that's in the contract, they just change their mind, the seller's going to get that, because it's kind of, hey, you wasted my time, I'm going to take that money. And that's how this transaction works. All right. Now, most of the time it's refundable to the buyer, whether it's their financing didn't go through all the way because of a reason they didn't know about, or something happened, or like the interest rates shot up. That's happened a couple times this year. Or there's a major problem with the house, right? So maybe the seller was living there and they didn't know there was like rampant mold in the attic until an inspector went in, and now they have this problem and then they have to spend a lot of money to fix it. And they're saying, wait, we can't actually sell the house. We have to put this money in it. That's not going to work. We're just going to stay here. The buyer's like, okay, the transaction's going to tear apart, and the buyer's going to get their money back in that case because it wasn't their fault, that they didn't know that the mold was there. All right. So anyways, don't want to scare a buyer, but that's the money and it's going to go down. So if you're putting 5% down, 5 times 300,000, 5% is what, $6,000? Is that right? No, that's not right. Help me out, Jen. 5% is 5,000 times 3, $15,000. So you're going to put 15,000 down for your loan, and you put 3,000 down already. So now at closing you owe 12. All right. So it goes towards that down payment and closing costs. The next cost that you've probably read ahead on is appraisal. $500 is a good amount typically. Now the lender is going to require you to pay for an appraisal because buyers and sellers on their own druthers can come up with prices that don't fit the market. And here's why the lender requires this, right? If a buyer pays a seller to take it off the market and they pay for the house, and say they paid for a $300,000 house, they paid $400,000, and the lender didn't get an appraisal, didn't force an appraisal. Well, now they stopped paying their payments, and they borrowed $400,000 from the lender, and the lender has to foreclose to get this house back and find out it's only worth $300,000. They've lost $100,000, right? They're the ones putting most of the money up, so they say, hey, Mr. Buyer, you have to get an appraisal, and it has to be someone that's unrelated to this transaction, so they don't have any buy-in one way or the other how much the house costs. They're just doing an independent appraisal. So that they force you to pay for that. That's $500. They're going to come through. They're going to say, yep, it's worth $300,000. You can do a loan on it, Mr. Banker. There you go. All right. The next thing is inspection. $300 to $1,000. Here's the range in the Indianapolis market, at least. $300 is going to get you a basic inspection. They're going to go through and look at all these different parts of the house and write up a report for you. Everything's great. You can add on all kinds of things. Too many for me to even remember on here, but some examples are sewer scopes, infrared cameras for air and water leaks, radon test, termite testing, all kinds of things like this. So you can add on, and that's why the price keeps going up. You can add on all these additional inspections if you want, and they'll go more and more thoroughly through the house with all that other stuff. So that price point's kind of up to you. They have package deals a lot of times, so I definitely recommend looking into what the different inspectors offer. And then lastly is closing costs, and I just put a note for myself to discuss this because closing costs mean so many things. It's one of those terms where people just call everything a closing cost, and it's kind of confusing. So the down payment could be a closing cost, the appraisal inspection could be closing costs. Like people call all these things. The closing costs to me are typically the costs associated to the title fees, and title fees are typically, so title is the middle entity that they're gonna have the office you typically sign the paperwork at, and then they're gonna do a title search, which means that they're gonna make sure that nobody has a lien on this house anymore once it transfers to the new buyer. That means no one can come back and be like, you still owe me money because I had a lien on this house and now it changed hands, so now the new buyer owes me nothing. Nope, it's clear and free, and there's actually title insurance that goes along with this, which is purchased, and so that way the title company is liable for any mistakes if they didn't find a lien against it. All right, so those are the closing costs typically, and how those title fees get split up is usually, does the buyer pay the closing costs, does the seller pay the closing costs? And a lot of times in Indiana, in a neutral market, it's just split. Buyer pays half, seller pays half. Now another thing that's commonly called closing costs are lending fees. So the buyer has lending fees because they're the ones procuring the loan for this home, and there's fees associated with their services for giving you the loan. Again, in Indiana, in a neutral market, the buyer typically will pay those because they're the reason they're getting a loan. They're going to pay those costs. But in different markets, depending off if the seller has the advantage or the buyer has the advantage, right now, most of the country's in a seller's market because there's not enough homes. So when a seller puts their home up, they're saying, hey, come, I have a great home here to buy, and I don't want to pay any extra costs. So the buyer's like, hey, I'll make you an offer where I'll pay some of the costs that you would normally pay. So that's where we're at right now in America. But that could change, and it could go the other way at some point in the future. But those are all considered closing costs. And so just work with your realtor and your professionals and your lenders to explain those in more detail if you have any questions. But those are a list of all the costs associated to a transaction. So if you're adding those up, you have your down payment. Your earnest money is part of your down payment, so it's not really an additional cost, but it's something you have to have right up front. So I make an offer, and then we pinned, boom, I need that money right now, not 30 days later. All right, but then your appraisal inspection are in that 30-day window, and then finally you take the down payment to the rest of the down payment to the closing 30 days later. So you kind of need all these costs within a 30-day window when you make up your mind that you're going to make an offer on a house. So be ready. And another thing I always tell all my clients is have these dollars liquid in an account in your city, right? Don't have them in some weird account where you got to sell gold and transfer it here and do this and wire it here, because a lot of this stuff is timed in a transaction and you only have so much time to do each of these steps. So when you're ready to buy a house, get it all in your local checking account. You can just go get a cashier's check at your bank for any of these expenses. All right. Now we're at the end. So this is questions. I'm going to go ahead and jump straight into a example on mortgagecalculator.org. You can see that there. All right. So we're going to kind of play around with these numbers and just go through some of the things I've mentioned today. So this is my favorite site. It's not the most graphically pleasing site ever, but it's pretty handy as far as how it functions. So again, I've been using $300,000 as the home value for most of the night, and we're going to switch this to percentage. So if I want to put 3.5% down on an FHA loan, and it always fills in this interest rate, so it's using where I'm at, probably my IP address to figure out where I'm at and see what it thinks is the rates. So I can't confirm or deny this is the rate you would get. You need to talk to your lender about that. But if you know your local rates or the rates of that day, because they literally switch every day, just like the stock market. So you can just leave it by default, or you can plug in what you know it to be otherwise. So term, again, the most common is 30 years. It pre-fills 30 years in there. Start date, you can leave there. So property tax in Indiana is 1% typically of the purchase price, or of the marketable price, or assessor price, tax assessor price. So if you if you go to 1%, you're going to cover what you need. It's a conservative number. I could get more complex, but I'm not going to. So 3,000 is 1%. That's going to cover your taxes that you're going to owe on the property tax. Property tax is a state-driven tax, and it's required, and the state will take over your house and sell it at a sheriff's sale if you don't pay it. So you have to pay that. PMI, we've talked about that during the presentation. They're putting 0.5 in there. I'm going to trust that. I don't know for a fact what the PMI percent is normally. We can look and see what it is over here in the payments here in a second, and it's got $83 right now is what you pay. So I'll explain that in a second. Home insurance right now in Indiana for the properties types we're talking about, it's going to be about $2,000 a year. It could be more, could be less. There's a lot of things going to that. Talk to an insurance professional. We can refer you one of those as well. Your monthly HOA. So a common HOA amount in the central Indiana region for an HOA that has maybe a tennis court or a basketball court, pool, usually more, but a monthly HOA or a yearly HOA is about $500. So when you divide that by 12, I think that's going to equal $60 a month, right? We'll say yes. I don't know if that's the right math. I don't think that's the right math now. Let's just do a calculator because I want it to be right. So 500 divided by 12. Yes, I was not right at all. Used to be good at math, not as much anymore, like the calculators. All right, so that's your monthly cost for a $500. That's pretty average HOA cost in Central Indiana. And here's your loan type. FHA is probably the most common first-time home buyer. And now that we've filled this all out, we're just going to click calculate. And we're going to go over here and talk about what this shows. So for this home, with this interest rate and all these figures that we've put in, my monthly payment, notice how it says with PMI, right? That's the start of the loan because I've only put 3.5% down, and PMI doesn't fall off until I get it 20% paid off, or actually 22 if I never call them and tell them to take it off. All right, so they're saying right now this is the monthly payment, $24.47 a month. All right, for a $300,000 house in Indianapolis, I'm probably paying $2,000 rent at least, if not closer to $2,400. So when I had the slide up saying you're paying your mortgage or someone else's, you're paying someone else's mortgage. You know that extra couple $100, it's worth figuring out, and that's why I started this whole presentation off with get a budget, right? Because you're probably if I'm talking to you and you're watching this, you're saying, see, Beau, it's $400, almost $500, $450 more to have a mortgage. No way I can do that. I don't have that kind of money. And I'm like, and my answer to that is that's because you don't have a budget. If you're saying that to yourself and you just said that excuse as soon as you said, I can't afford that, well, you're probably paying $2,000 rent. So the question is, what's $450 in your budget? There's something in your budget that's costing that. I guarantee you, whatever it is, it's not as important as owning a home and getting 40 times more net worth and becoming a millionaire eventually, because you know how home ownership works. All right. So figure it out. I hate to be just the hard aid to give you that feedback, but figure out how to get the money, because it's going to change your life. All right. And then over here, you see after 133 months, then you're 20% paid off, and that PMI payment, this amount. So this minus this equals that. So then your mortgage payment is going to go down because you're going to have PMI taken off. All right. And you're going to pay $16,000 insurance until that month. It tells you exactly when it'll fall off because you didn't put 20% down. So if you're thinking like, oh, I could put 18% down and borrow a couple thousand from a family member, because if you can borrow it and get 20% down, then boom, you save 16 grand. It just is kind of wasted otherwise. So that's just a tip, part of this. So down payment amount, so 3.5% equals $10,500. That's what you need to save up to get this loan to work. All right, there's the 3.5. We're going to go down here. The payoff date, of course, it's 30 years out. That makes sense. So you pay a lot of interest in loans. So there's tips, and we got about 12 minutes still. So one tip is if you get paid every other week, like a lot of Americans do. So you get paid every 2 weeks, essentially. There's a difference between getting paid every 2 weeks and twice a month. So if you get paid on the 1st and the 15th every month, you get paid twice a month. You get 24 paychecks a year. This trick won't work with you. But if you get paid twice a week, no matter what, every second week on Friday, you actually get paid 26 times a year. If you figure it out, 52 weeks divided by 2 is 26 payment. You get paid 26 times a year. So if you actually pay your mortgage, half your mortgage every time you get paid, then you wipe out 7 years of interest on your mortgage payment. Tip of the day just for watching this. So it's huge amount less if you pay 26 times a year versus just 12, which would be your monthly mortgage payment, right? So awesome tips. There's a bunch of stuff like that. We can, again, reach out and do one-on-one. Your monthly tax payment, that's this property tax that goes in, that's part of your payment. You're just paying the lender this. All you're doing is sending off the money. They're chopping it up and they're putting $250 aside because the state only collects taxes twice a year. And the lender is not going to let you pay the taxes directly to the state because the state has preference over the lender. So if the state doesn't get paid, they said, you know what, Mr. Lender, I know you have a mortgage and a lien on this house and you can foreclose on it, but we get first dibs. So if we're not paid, then you don't even get it, Mr. Lender, we get it. So then the lender says, you know what, I'm not going to let you, Mr. Buyer, worry about that because I can't take the chance that the state can take it away from me, the lender. All right. That may be confusing if the first time, but just know the lender's not going to let you pay your taxes. They're going to pay them for you. They're just going to charge them through the main payment. All right. Same thing with insurance. They're not going to let you pay your insurance to Allstate or Progressive or State Farm or whoever you have. They're going to collect that, and it's going to be part of this monthly payment. It's going to be this number right here, and out of that number, they're going to take this number and set it aside, and they're going to pay that insurance payment as well, because they want to make sure that if something happens, fire, tornado, whatever, and you're like, hey, my house burnt down, so I guess I'm not paying my mortgage payment anymore. Well, they're going to say, well, I can foreclose on it, make an insurance claim, and get it rebuilt, get my money back or whatever. So again, banks don't play around. They're going to make sure they get their money. So they're not going to let you pay these bills. They're going to pay them for you, and they're going to all be wrapped up into that one mortgage payment every month. All right, your total HOA fees, that's over the whole life of the loan. But it's part of it. If you want amenities in your neighborhood, you're going to probably pay HOA fees, at least in the suburbs of Indianapolis. Your insurance, life, and then annual payment. This is how much money you're paying every year when you add this up times 12. You're paying $27,000 a year. Now it's broken up into all these little chunks, but just think about that. You're paying this and you're decreasing your loan and getting richer every time you make a payment. It's like a forced savings account. Whereas if you're paying a landlord, guess who's making $27,000 a year off your money? So the theme of this whole thing is, if you're renting and you're thinking about being a first-time home buyer, this should be enough. I don't know if this doesn't convince you. I don't know what does, because when you look at a number like 27,000 and then you think 3 years renting and you just had $100,000 that basically evaporated into the thin air, and then you in that presentation number I said they're 40 times more net worth. You're like, how could that be? Someone with a house is 40 times richer than I am, and it said 250,000 net worth to 6,000. That's such a disparity. There's no way that number could be right. Well, just think about this: almost 30 grand a year. Boom, boom, boom. 100,000, 3 years, 3 more years, 200,000 difference. So yes, it adds up extremely quick, and it will build your net worth, and your life will get much better, much quicker through home ownership. So that's a great spot to end on today. I hope that this presentation has been helpful and informative. There's no way I even really scratched the surface. There's so many more, little bits of information and things I can go over with you in person and personalize it to your situation. So I hope that if anything, you'll just reach out to us, ask more questions. We'd love to help you here at Beau Benjamin Realty Group and walk alongside you to home ownership. Thank you for watching this, and be well.